Thanks for checking out this video from NetPicks, and today's lesson we're going to cover the Double Exponential Moving Average, otherwise known as the DEMA. And to me, the DEMA is more of an aggressive EMA. And what it does is it uses two EMAs in the formula to help eliminate the lag that's involved with virtually every single price-based technical indicator. And the DEMA is considered an improvement, of course, over the standard moving average, because it's using a smoothing feature of the exponential moving averages, and also uses the standard EMA. Now, Patrick Malloy, he invented this back in the 1990s, and he did so because he wanted an indicator that could take out some of the lag that's associated with the moving average. And of course, 100% removal of lag, it's not possible because indicators are derived from price. But this reduction in lag that he got with this indicator produced an indicator that's more responsive to the changes in price. Now, this is a daily stock chart of Apple. I have the DEMA, the EMA, and just a simple moving average. Okay, and all periods, I just set them to 20. Okay, now it's clear that the DEMA stays extremely close to price, which is going to have that indicator reacting quicker to changes in price than the other two. Now, the quicker reactions, that might suit the need of short-term traders and swing traders because they want to be a bit more responsive to changes in the volatility and trend reversals. But a longer-term investor, you may not be as concerned with getting these short-term changes, unless, of course, the longer-term trend is affected. So how do you calculate it? He explained that it just used the following formula. Right, N is just the look-back period, and that can be any number you choose. And this may look a little bit confusing, but all we're doing is really multiplying a standard EMA by 2. We're using another EMA with the same look-back, acts as a smoothing EMA. Then we multiply the EMA by 2 and subtract the smooth EMA. So essentially, we're just using the EMA of an EMA for the indicator, and that's what you're going to see in the chart. And, be honest, knowing what's behind the indicator is useful, right? But your trading software is going to do all the heavy lifting and plot this for you. So at its core, really, this is just another moving average, okay? And as a trader, you're going to use it much in the same way as any other moving average. Trend direction, support and resistance, to moving average crossovers, right? There's a variety of ways that you're going to use these in a trading strategy. One thing I find is really important is the look back period. Okay, because of the lagging feature and how you plan on using the DEMA, right? Some periods are going to mingle with price, okay? And it makes them not very helpful. Now, essentially, one of a great feature of a moving average is that when it snakes through price, that's helpful, right? Because it's often a sign of a choppy market, the formation of a trading range, and traders can stand aside. But this black line is a 9-period DEMA. Now, the indicator stays inside of price for a majority of the time, even when the price is trending, right? So that takes away the choppy market indication. Okay? And a trader will just need to read price action for that market condition. Hey, look at the green lines at 20 period and the red is a 50-day. They don't engage with price as much. So the lower the look back period, the more volatile the indicator is going to be. A higher setting is going to have less whipsaw, and it just might be a little bit more useful for a trader. Now, when we talk about support and resistance, this is where price will seemingly bounce off the averages. I personally do not follow that line of education. If you've watched any of my videos, talk about moving averages, that's not something that I buy into. I discard the notion that moving averages act as support and resistance. Right? There's plenty of moving averages out there, different types, from the Hall average to the simple moving average. And it's naive to think that institutions watch them, right? That's the explanation why they work. Or there's a whole bunch of different ones in different settings, so who knows? But when you do find price reacting to an area around any average, look left. Okay, no doubt you're going to find some sort of price structure that is affecting price. Trend direction, well, with the less lag feature, using the double exponential moving average, the DEMA, as a trend filter, just as you do with other averages, it's viable, right? And in this case, you'd be alerted to a change in trend earlier than a standard moving average. But again, the key is, what do you determine to be a trend change? Is it the slope of the average? If price crosses the average, did the trend change direction for you? Do you need price holding above or below the indicator for a change in trend? So if we look at this chart of Bitcoin, it's a daily chart, and it's a 20-period DEMA. We have multiple trend changes using price trading above or below the moving average. So for this example, we would look for price to break the average and then have some trading activity after the break. Okay, you're going to ignore weak breaks when price doesn't hold, and you're going to look for those areas that are done with some momentum. Now, we can also look for lows above or highs below the average to signal a change. And I'm going to talk about that in the next example here. So in this chart, we have price breaking the indicator, plotting two higher lows completely above the average, or two lower highs below the average. Now, we would consider a break of the highest high of those two candles, or the lowest low of the two candles, as confirmation of the trend change. And then you would use whatever strategy you use to find entry points into the market. We can also use two DEMAs. And a really popular approach, for some reason, is trading the crossover of two or more averages. And while trading the actual cross is not something I would ever suggest, we can actually use the indicators for a trend determination and also as an area of value for a pullback. So for a trend change, we're going to use the exact same trend direction method I've already talked about. And then we're going to add another layer of confirmation by just requiring that the 15 DEMA has crossed over or below the 50. And then traders would just look for a pullback into an area of value between the 15 and the 50. Now, bear flags and bull flags, along with triangles, they're my favorite patterns to look for on the charts. So using an area of value ensures that price is showing a reaction against the main direction of price, right? So this is going to avoid you trading in slow, grinding, painful markets, as we see on the left side of this chart. That'd be a tough to trade inside of. Some final thoughts. When we use the most recent price data, which all EMAs do anyway, it can actually go a long way in your ability to read the current state of the market. The DEMA, because of the calculation, is going to react even faster than a standard EMA, and that might benefit, a certain type of trader. The look back period you're going to use, that matters. A 9-period look back could be wrapped up in price for a lot of the time, making it pretty much useless. But the upside to the faster one is if price does pull far away from it, we can then determine there's strong momentum in the market. We could just look for simple consolidation breakouts in the direction of the trend, right? And there's always that question, does a trading indicator work? See, the problem with that question is defining what work means. All a technical indicator does is present information in a certain way. And what you do with that information, that's what determines if it works or not. Put on your chart, check it out, see if it suits you. Hope you enjoyed the video. If you liked it, hit me a like, hit that red button for subscribe. Any questions, comments, hey, definitely pop them below, and we'll talk to you soon.